All right, what's up, everybody? Welcome to another interview in the Trust Engine Mortgage Coach community. I am doing a follow-up interview with Mitch Kider. Last time Mitch and I talked was first week in December, and we had a topic around buyer commissions and where things were going. We talked about fair lending, we talked about RESPA, we talked about JVs. And so for anyone who doesn't know who Mitch Kider is, he is the leading compliance attorney in the mortgage space. I've interviewed Mitch countless times for many years. He's always super gracious to, be a thought leader. We actually have a playlist for Mitch Kider, and I started it with Mitch Kider's homeowner story. So for those of you that want to go a little deeper on this, go check it out. And hey, Mitch, one thing I've never asked you, because I noticed it in your bio before today's call, you've authored 6 books on mortgage banking. What are the 6 books? I don't think I know about them.
Books. Well, the last 2 are basically textbooks. One is on all of the mortgage banking laws. The other one that I authored was on the creation of the CFPB and Dodd-Frank and the law itself. My publisher has always been Thomson Reuters and Westlaw. So those are the last 2 books that I did. I did a book on escrow accounts. I did books on quality control in general and quality control for mortgage services. I authored a book on the secondary market. I can't even remember them all, to tell you the truth, but over the years, I've authored 6 books on mortgage banking. That's right.
That's awesome. Yeah. And I do think when we first started doing these interviews, it was about 9 years ago, when TRID was coming, and they were absolutely the most viewed interviews of the year. So thank you for the leadership over many decades. And I think we're on the heels of another major pivot in housing, with this NAR settlement. How big of a deal is it, in your opinion?
I think it's a big deal. I think it's a really big deal. It's shaking up a system that's been in place literally for decades. I think that the changes that are going to come around are going to be fairly significant, but I think it's going to take some time. I think you're going to see a variety of different changes that are going to evolve over time as people find themselves and figure out what works and what doesn't work along those lines. But it's a very big deal. It's a big deal for real estate agents. It's obviously a very big deal for buyer agents. And it's a big deal for mortgage bankers as well. I mean, the mortgage coach community is made up of loan officers, and the principal referral source to loan officers is typically buyer agents. And so what impacts buyer agents are going to impact these loan officers as well. It's a big deal.
Yeah, no, I agree big time. And I definitely think it's going to drive, both mortgage and real estate professionals to be more data driven. Like, I think the value of databases has gone up in value. I think the industry is going to need to be more process driven. When you really look at the role of buyer agents going forward, it's going to mimic more like the role of a listing agent, where they give a presentation, they negotiate comp, they get a signed agreement. By the way, do you have any idea what percentage of buyer's agents are getting signed buyer's agreement? I think it's a really small number. But...
it's a tiny percentage today. I mean, today what typically happens is that the market has changed, over the years, but the compensation structure of buyer's agents and what they do hasn't changed that much. Today, most people, probably at least 50%, but I would guess more than that, in all honesty, find their homes online, or at least they find their communities online. And what do they do after they do that? They ask their friend, or they call their friend who happens to be a broker. They either ask their friend if they know someone, and they get a broker, and they say, hey, I'm interested in buying a house. Can you show me this and show me some others that are there? There isn't even a conversation about compensation when that occurs. So, this is going to be very different. This is going to be a big change. And there isn't a conversation when that occurs, because most people just assume, hey, someone's paying for this, but I'm not paying for it. That's going to change.
Yeah, no, totally agree. Well, before we dedicate the entire conversation to just unpacking this, I also had some executives and leaders submit some questions to me that they want me to ask you. I just want to find out, what are any other things really impacting lenders and loan officers? And, what are some of the top priorities besides NAR in today's marketplace? Anything else you want to hit before we just dig in on NAR?
Well, let's start off with compliance-related matters, okay? Some of the biggest issues out there today revolve around loan originator compensation, and more specifically around this bucket system. A loan originator can get paid X amount of basis points when they go out there and they find that lead themselves, and they originate that loan, and they could get less basis points, Y basis points, if it's a company generated lead. Well, there's a big issue in the industry right now of making a deal happen, and loan originators supposedly moving from self-generated leads to company-generated leads so that that deal could otherwise happen. And that's a big deal, and that's a big issue. And there have been so many complaints about that practice, both from loan officers, disgruntled loan officers when they leave their companies, and from companies that don't allow that particular practice, to tell you the truth. And I think the CFPB has heard those complaints. So there are ongoing investigations that are looking into that. And I think you're going to see things come out along those particular lines. Another issue from a compliance perspective that has really picked up, it's slowly picked up after FHA changed their conflict of interest rules, but now it's really taking off because everyone's looking at how they can utilize real estate agents on the mortgage side. And so another big issue is, can you employ a real estate agent as a loan officer? And if you can, under what circumstances, and how do you structure that properly? Does RESPA still apply? And the answer to that is yes. So you've got to be really careful along those particular lines. That's a big issue in the industry today. And of course, there's fair lending. And the biggest issues today in fair lending, it's still this modern day redlining, but also pricing concessions and the use of discretion and being unfair as to who gets the concession and who doesn't. So those are three big issues that lenders ought to be thinking about, and certainly regulators are thinking about.
Yeah, before we jump into it, I just want to unpack the price concessions, because we're seeing a big pickup in MortgageCoach adoption. We're seeing executives get more aggressive at having their loan officers use it. And at first it was from a price exception standpoint and a conversion, that when a loan officer delivers advice with price, they convert more of them. They have more success. And given the challenges of the industry, it just made sense that we'd see that. But now with this NAR settlement, it's becoming more and more, I think, obvious that lenders need to, create more value for the buyer, and a total cost analysis is obvious value. So they're starting to see that as a real advantage. Any new thoughts on? I mean, you've always been a big fan of our, MortgageCoach experience, but do you agree that it's maybe even more valuable going forward, given the market dynamics?
I think it's absolutely more valuable, given the market dynamics. The bottom line over here is LOs, lenders and LOs are going to find themselves in a little bit of a different situation as a result of the NAR settlements, when things shake out, and changes are implemented. And, that first point of contact and first time you sit down with that consumer, and the information and advice that you provide to that consumer is absolutely essential. It's always been essential. Now it's going to be even more essential, because some of that they're not going to get anywhere else, in all honesty. And they need to know and understand the transaction, and they need to have a trusting partner right up front to help walk them through that transaction. And, that's what you do. That's what you do with MortgageCoach. So.
Yeah, well, and I think the other part of it is, not only do we help make a good transactional choice, but we help them look at the long term. Like, how is that going to perform over 5 years, 10 years? And let's face it, when interest rates are as high as they are, people aren't getting loans because they love their rate and they like their payment. They're getting loans for the long-term play, so, hey, one more question before we dig in. We're also, because we're helping lenders with their databases, we're starting to hear like some of the new lead laws are coming into play.
Yeah.
Where, like the lending tree, where it's one one lender referral per express consent. Any updates you're aware of on just how databases are used and how leads are distributed, and when that's coming down?
So you hit it right. You hit it right there. What you're talking about over there is coming out of the TCPA, and that is you get consent to call the consumer, but that consent is only for yourself and for whatever one party you have along those particular lines. Once you sell that lead, the purchaser of that lead needs to get consent themselves. So that is a big change. That's a big change. Regulators in general, I mean, the CFPB has been looking at, lead sources for a while now. And, last year they issued their advisory opinion on comparison shopping on the internet. And they took a look at a number of different providers that were listing out different mortgage companies and their rates and allowed the consumer to do comparison shopping. And they said, no, this isn't working really well. This has to be completely objective and completely neutral in nature. And that's what you're finding out there. So there's, the generation of leads and the sale of leads is being attacked and being addressed in a number of different instances. Number one, how you get onto that list. How do you get that lead? And is it based on objective factors and what's being disclosed to the consumer themselves? Number two, do you even have the ability to call? Once you purchase that lead, do you have the ability to contact that consumer to solicit that particular lead? And what kind of consent do you need along those particular lines? And I think we're going to see a lot more of that, quite frankly.
Yeah. So just netting out for anyone listening to this, if you're a producing branch manager, you're a head of production, and you're responsible for your loan officers, it's more important than ever that you professionalize your sales force. They need to become data-driven. They need to deliver advice with price. And the days of just being a loan officer that can pre-approve a consumer, it's not enough to thrive and gain market share going forward. So Mitch, let's get into the NAR settlement. Are there any particular thoughts you want to start with, knowing that, while there are mortgage executives watching this, probably the majority of the audience is loan officers, and the executives are listening to it. They're listening to it because they want to bring leadership to their loan officers and help them be better partners to realtors and help them be better, more valuable partners to home buyers. So where do you want to start on it?
So, I mean, we already started this conversation and we talked about whether or not this is significant, and it is significant. From a mortgage banking perspective, from an LO perspective, from a lender's perspective, it's significant as well, not just to the real estate agents. As I said, your primary source of referrals are in fact these buyer agents. We don't know what's going to occur with these buyer agents, and I think what you're going to see are different things in different areas of the country and different things, coming into play over time until a viable model comes out that others want to jump on that particular bandwagon for. Buyer agents have, as a result of this settlement, they have a number of things that's being imposed upon them. Okay, disclosure requirements, a buyer agency agreement that articulates exactly what they're going to get paid. And all of that has to be implemented, on a per transaction basis before you ever show a consumer a home. That's really important, right? And, sellers may or may not end up picking this cost. It's going to be somewhat market driven. We're in a seller's market today. Right? And in the seller's market today, a seller doesn't necessarily have to agree that they're going to pay for that, for their buyer's agent. They don't necessarily have to agree to do that in a seller's market. They're in a better position. Although if the offer is good enough, and it's a really strong offer, then they'll do it, but they're going to do it by way of a seller concession. That's how they're going to do it. So I guess the first impact that I see on mortgage companies and loan officers are, where are the referrals going to come from? And I still think that, for the time being and for the, foreseeable future, for the most part, those still going to come from agents and from buyers agents. In time, there are going to be others that jump into this particular marketplace. There may be a model that comes out that's fee for services rendered that supplants what some of these buyer agents are doing. Where a consumer hires someone and they provide certain services and providing advice and guidance and things along those particular lines, and they pay them for that. So I see others entering into this industry, and I think that mortgage companies and loan officers need to stay on top of that and see where the market is going and see who's important to them and see what other players come into the market that's important to them. There are issues of buyer affordability that have to be addressed with this, in all honesty. You've got, a buyer now is going to have to sign, if they want to retain a buyer agent, they're going to sign an agreement that's going to make them legally responsible to pay that buyer's agent. It's going to have an amount in it. It's going to be full disclosure and everything else along those lines. You know, can it be covered by a seller concession? It can. It can be covered with a seller concession. But, a buyer up front may not know whether or not there's going to be a seller concession there. And so, there's an impact to that. And if there is a seller concession and the seller picks that up from a financing perspective, how is that going to be treated? That's the question. Is it an interested party contribution for Fannie Mae, Freddie Mac, and FHA, or is it not an interested party contribution? All of those issues have to, are going to have an impact on the lending business, and in time they'll be answered and they'll shake out.
Yeah, one of the questions that was submitted by Mortgage Executive to me was, do you have any thoughts on how lenders will look at rolling buyer agent compensation into the transaction? And specifically, will FHA or VA allow this, and new rules around buyer concessions and gift funds? Do you have any, crystal balls on that?
Yeah, well, this is my crystal ball on that. I don't think that the buyer agent's commission ultimately is going to be rolled into the transaction by way of financing. There are many reasons, there are some reasons for that. There are many reasons that shouldn't happen. A lot of this is an affordability issue that's going to govern how the agencies otherwise react to that. I'll be surprised if they fall into the position of being financed. Okay. The other issue that goes to your question is, how are they going to be treated in terms of when the seller picks it up, if the seller picks it up, the seller concession. Now, historically, traditionally, buyer agent commissions have been paid by sellers. It's not the type of item that typically would be included as an interested party transaction, because an interested party transaction is when the seller or another interested party in the transaction goes ahead and pays some of what otherwise would have been buyer's costs. Okay, this is typically not a buyer's cost. My guess is that we're going to continue to see a marketplace, regardless of the fact that the buyer signs an agreement legally binding them to pay a commission. We're going to continue to see a marketplace for the foreseeable future where that amount somehow is being covered by the seller, typically by a seller concession. And if that continues on along those particular lines, and it's typical that sellers pay that amount, then I think Fannie Mae, Freddie Mac, and the agencies themselves are not going to treat that amount as part of the limits as for seller concessions. So I think that will ultimately be helpful.
Yeah, and I completely agree. By the way, I just noticed a comment from Eric Wiley and Facebook. Hey, Eric, if anyone is watching this live, you can put a question in here and I'll ask Mitch. And if you're watching this on YouTube and it's not live, still put your questions down below because I'll be interviewing him again sometime in the next couple months, assuming Mitch is game for that. Hopefully, you've
Absolutely.
never said no to me yet. So,
No, I wouldn't. I
yeah,
wouldn't.
I will. Well, I appreciate that, brother. So, when I look at this, some of the good news for the mortgage industry is that it's going to get buyers agents to be more process driven, which
Mhm.
I think will make for better partnerships. It's going to make the buyer agent need to get the lender involved, like right at the beginning, because to your point, they're not going to be showing a house until they get an agreement signed. And I do believe this is a huge opportunity for, let's just call it the most professional lenders that are delivering a mortgage coach rep versus own for a first-time home buyer, or they're really giving this mortgage plan to people. That's going to be something that the buyer agents what's like, hey, look at all the, look at the lender that I'm referring you to, look at the value that I'm bringing to you. I'm helping you make a wiser decision. Any do's and don'ts as and let's face it, lenders are going to be rushing to be like the most valuable lender uh, to help you get your buyer's agent or your buyer agreement signed. So any any just it's going to be a whole new obstacle course, and which brings opportunities, but it also brings new risk.
Well,
Any thoughts on that?
yeah, you raise a whole lot of interesting points along those particular lines. First of all, I have believed for a long time that loan originators should be the first point of contact in a transaction. The consumer needs to know, what's a transaction generally going to cost me? What are the costs associated with it? What do I qualify for? So what do I know? What do I have to know in order to step into this marketplace and proceed with looking at homes and buying a home? And, it's always been a little strange to me that lenders come after the fact as opposed to before the fact along those particular lines. I think that you're going to see lenders being the first point of contact more often, in all honesty. I think you're going to see that lenders will become much more important to buyers agents because it's going to be the lender that educates the consumer as to the importance of that buyer's agent as well. And I think the interaction between the lender and the buyer's agent, as you said, is going to increase quite a bit because they're going to become more interdependent upon each other. Okay. The lender's got to help educate the consumer as to the importance of having a good agent to help you in that home buying process. The agent, if they're the first point of contact, and they will remain that way for a long time, but not always. I think that will evolve over time. But the agent has to, as you said, provide real value to that consumer. They're not going to be able to just walk in the door and start showing them homes until they have an agreement. So what can the agent share? Are they putting them with a good lender partner? And does the consumer like what they've seen and what they've heard from that lender partner based on that agent's recommendation? And and that agent's relationship with that lender partner as well. Do's and don'ts. So, obviously one of the do's are, educate the consumer. Educate the consumer because, I've said this before, I've said this many times, that's your best customer. And you want a consumer for life. You want that relationship to stick. So you want to educate the consumer. That's first and foremost. That's your client, and that's where your obligation and your duty and your responsibility is owed to that particular consumer. And I think that includes educating a consumer as to the importance of in some cases, probably in many cases, of having a good buyer's agent that assists them and helps them through that transaction as well. So that's number one. Number two, don't overstep. Don't overstep your role in doing that either, in all honesty. Don't find yourself in the position of effectively being that agent. because that doesn't make sense and that's not your business, right? So that's an important thing in terms of do's and don'ts as well. And don't start coming up with these crazy schemes, because I'm seeing a lot of them that says, don't worry, agents, because your commissions may go down. No problem. I'm going to bring you in and I'm going to find compensation for you in other areas. I think that's a mistake, in all honesty.
Yeah, no, agreed. And a caveat I will offer anyone listening to this right now, and if I was a producing branch manager, head of production, it's time to really double down on training your loan officers to bring more educational value at the point of sale. And Mitch says, educate the consumer, and I'm going to say beyond the transaction. If it's someone that's renting, you need to help them make the decision, owning versus renting, and what that looks like over time. If it's a move-up buyer, first of all, 63% of people with, homes and mortgages today, they're quite low. They're under 4%, and 80% of them are under 5%. And so, providing a move-up analysis, you're going to find that if your loan officer, so your head of production, Eric, talking to you, and any other executives, if your loan officers can really deliver an incredible experience to that consumer, where they're saying, wow, I never thought of it that way. Wow, this is really helping me make an informed decision. That is going to be more valuable to a realtor than ever. In the past, all realtor, and I'm going to exaggerate to make a point, all they cared about was that you closed the deal and you closed it on time. That's still going to be, essential and important, but they're going to care more about, how did you make me look at the point of sale? And did you help me justify my expense as a buyer's agent? That's not how agents are looking at things now. So it's time to train, and it's time to upgrade the mortgage industry. Any thoughts on that, Mitch?
Oh, I think you're absolutely right. And that's what I meant when I talk in terms of the increased interdependence between, or dependence between, the loan officer and the real estate agent right now. Buyer's agents today view themselves as, effectively controlling that particular consumer. And for the most part, they do. And picking the services that the consumer is going to, the service providers that the consumer is going to utilize. And so they view themselves in that position of being able to, effectively control the course of that transaction, which is very important to the lender, because they certainly want to gain the trust of that particular of that buyer's agent, so that they will get those referrals coming through. Now it's going to become a little different as well. Now the buyer's agent is going to have to rely upon the lender as well to help them justify to the consumer their value and their need. And I think it's incumbent upon lenders and loan officers to understand that new role. So yes.
Yeah. And so real quick, I'm going to put a link down below to this, but Mitch, I have been doing a lot of training that's really designed specifically for the producing branch manager, because I really feel that's the most important job in the sales force, and it's the hardest job. And so I've been, creating a lot of content that's for branch managers, like just, hey, branch managers, use this as a training guide. And it's everything from how to use our product to strategic selling. Any closing thoughts you have, and speak directly to the producing branch manager on how they can, one, be compliant, two, turn the shifts that's taking place in the industry into a competitive advantage. Because, we've done a lot of interviews where I call turning compliance into a competitive advantage. But anything specifically, knowing that you're going to have hundreds, possibly thousands of branch managers watching this, any advice you have for them?
So my first piece of advice is non-legal advice, and it's something that you always need to keep in mind. And that is, you want to create a client or clientele for life. Don't just look at the individual transaction. Look beyond that as well. Look at what value you're bringing to the table for that consumer. Because if it doesn't work out in this one transaction, they're going to come back to you for the next one. And they may come back to you further down the road for refinances, new purchases, and things along those particular lines. That's number one. Number two, branch managers, are not typically the parties that you look at for compliance purposes. They rely upon the compliance department to take care of those particular things. But I think branch managers need to get more involved along those particular lines. I think they need to educate themselves and their companies need to educate them as to what the compliance requirements are. When you're out in a retail branch and you have loan officers that want to market themselves, okay, and put out digital advertisements and create relationship with real estate agents and real estate brokers and things along those particular lines, not only as a branch manager do you need to know about it, but you need to know whether or not what they're doing is in fact compliance, okay? Because what makes a lot of sense from a business perspective, okay, unfortunately, sometimes doesn't work in the regulatory environment that you're in today. And that's a really important thing. So, educate yourself along those particular lines as well, and make sure you're playing a role in that particular process.
So I love that you just called out the long-term value. I mean, at Trust Engine, we're trying to do a couple things, but we're trying to be more predictive in the database to really identify who's and really go beyond triggers. Like, let's face it, when someone's running a credit report with someone else, they're in the market. In best case scenario, you're in a long list of lines. So how can we get more predictive so we can be more valuable in using life events and using non-credit data to really identify, who's most likely to need a transaction? Do you agree, like, in this, and I don't know what we're going to call it, but this post NAR settlement era that we're in, both real estate agents databases and mortgage professionals databases, and how predictive they are and how well they give advice with price has gone up in value. Like, it's 3x in value.
It's absolutely gone up in value. And by the way, trigger leads are going to go away. I mean, there are 3 bills pending right now in Congress that would outlaw trigger leads. And, maybe servicers will be able to obtain trigger leads under certain circumstances, maybe. But otherwise, for the most part, that's going to go away. And as you said, trigger lead itself really addresses an immediate transaction. So some lenders looking at it, oh my God, that means they're in the market. We want to grab them right away. You need to anticipate. And how do you anticipate? You anticipate with data, with the knowledge you obtain from that data. You need to know where the market's going, who's going to be in that particular market, and what you need to address, their particular needs. And that's going to come, that's all going to be data driven, in all honesty. So,
yeah. So anyone listening to this, if you want to learn more about how we are helping lenders be more predictive and going beyond trigger leads, and hey, we know we have Sales Boomerang, and we have a lot of lenders that are doing that, but we have more lenders now that are like, how can I be more predictive and how can I be more valuable to the consumer? So Mitch, what are the best ways for people to follow you, learn more about your firm, and reach out to you? What's the best way to do that?
So a variety of different ways. Number one, you can follow me on LinkedIn. Send me a request. I'd be happy to have you follow me. And I constantly, probably 5 days a week, put updates on regulatory compliance matters and what's going on in your industry on my LinkedIn account. You can call me. I'll give you my direct line. It is 202-557-3511. Or you can reach me by email, and that's kider@vwbkfirm.com.
Well, I checked you out on LinkedIn, and I always follow you. You truly keep the world of mortgage updated. Thank you for always being willing to jump on these Zoom calls and bring value to our community. I'm super grateful for you, brother.
Hey, it's my pleasure. Thanks for having me.
All right, everyone, if you got value, give this a like, share this with your leadership team, share this with all your mortgage friends. And if you haven't already, make sure you subscribe to our YouTube channel. Take care, everybody. Have a good one.